So we're going to try to answer the age-old question on whether real estate or stocks is the better asset for generating quote unquote passive income. So what's up, you guys? Zoeb here from oneglancetrader.com, and I'm super excited about this video because I can speak from experience because, as you guys know, I own a lot of stocks and I also own a little bit of real estate. And I don't talk about real estate on my channel because it's more of a trading, investing in stocks and forex kind of channel. But I thought it would be good for you guys to look at a different asset class and compare the two together using my own real life examples when it comes to real estate and a fictitious example when it comes to holding stock, because I don't have that amount in one particular stock for the example I'm going to show. It would be nice, but I've decided not to go down that route. So I just want to share with you the good, the bad, and again, from my own personal experience of the everything outside of the numbers in terms of time invested in both of these different asset classes and all that kind of good stuff. So, if you get any value, please make sure you like this video and also smash that subscribe button, because it's all about investing, making you money, and helping you within your investing career. And one way to do that is get up to 5 free stocks worth up to $3,500 each with the trading brokerage Moomoo. 0% commission across all the main exchanges, and it's growing. Link is inside the description. If you click on that, you can sign up to get up to 5 free stocks. So don't miss out on this particular offer. So when we're looking at this, there's got to be a lot of assumptions on here, right? And again, comment down below if you guys have different views and thoughts on this. And again, it's not going to include every single piece on here. So I'm going to go through firstly the real estate example. And there are overall assumptions for both asset classes. There will be some house assumptions, and there will also be some stock assumptions as well. So from an overall assumptions point of view, I'm not taking into account anything regarding capital appreciation from a growth or a decline perspective. This example that I'm going to run through is all going to look about how much income the asset produces as an ROI against the initial capital that you invested. And again, I'm also not talking about taxes because both asset classes are taxed differently. One's based on more of your income, the other's based on capital gains. But then at the same time, are you doing this through a company? Are you doing it through your own kind of name? All these kind of different things. So we're going to keep it simple and just take the pre-tax profits or losses that are kind of come up with these particular example. So the first one we're going to look at is the house. And what I've done here is, again, I've taken an asset or a property that I purchased a couple of years ago, as well as benchmarking against some averages to come up with some of these numbers. So what we did is we looked at the price of the asset. And again, I've converted these into dollars to make the comparison easier when we look at the stock example of $310,000, which is around the average house price of a UK, which is primarily like a two bedroom or 3 bedroom apartment. And then in terms of the deposit that's needed, right? So to get an investment property that you're looking to rent out in the UK, the minimum you need is 25% deposit. So 25% of the 310,000 is just $77,500, which means then I'm going to borrow from the bank at 232,000 and a bit at a 75% loan to value, and that's typical for most investors that are investing inside the house. That's the minimum that you need. There are also some other one-off purchasing costs like legal costs and property costs like stamp duty inside the UK, and other agency fees and all of these other kind of different things. And I've used basically percentage multiples that I used when I purchased the property that I did to kind of come up with these numbers. So the total investment that is needed, that is coming out of your own pocket, is $93,248. So that's the amount of money we've put in. In terms of from an income perspective, so in the housing example, we are going to be collecting rent. And throughout this assumption is that we have 100% occupancy, and I've used the rent value that I'm currently getting for my property, which I purchase at the same price in this particular example. So then what I've done is times that by 12 to get the annualized view. So it's just shy or just over $28,000. There are no dividends in this particular example because it's a house. So my total top line revenue or income that's coming through the door is the same at just over $28,000. There are obviously some costs as part of that. So obviously you have, the interest on the mortgage. And again, I've used a standard 3.5% kind of mortgage interest rate, having a quick look around online. They're around that. But again, it does assume that you have pretty good credit around there. Fortunately for me, I got it a bit lower than that. Because of before, inflation and interest rates went up. But I'm using kind of today's figures on that piece. So then we've got management fees. So I have a letting agent that is managing my property on my behalf. And then what I've also done is I've used average costs for the similar property size, which is very similar to the amount that I pay in maintenance, insurance, and kind of service charges or ground rent. So when you add all of that together, that's just over $18,500. You minus those two numbers between the income and your costs. Your profit or quote unquote passive income is $9,671 for the year, which is an ROI or a yield of around 10%. And again, if you've got any questions on that, please comment down below. But hopefully that is quite straightforward, and I have simplified things, and hopefully the assumptions on there kind of make sense to you. So, on the face of it, making 10% a year, and we all know that from an appreciation point of view, is that house prices keep going up roughly around 5 to 7% a year. So you're going to get a nice chunk of change when you decide to sell it in 5, 10, 15 years time. But you are picking up passive income or making a profit on your investment while you're waiting, right? Which is all good. And now what we're going to do, we're going to look at the other side of which is stock. So the stock in question we're going to be looking at is Apple. And the price of the asset or per share at the time of recording is $154.51. So what I wanted to do is, because I've invested 93.2k from a housing perspective, I also want to invest the same amount to give you a like-for-like comparison on the return of the investment that is needed. So I've invested 93.2k. I've decided, again, because I'm borrowing money from here, I'm going to borrow money as well on a margin account, and Interactive Brokers, who are my current broker, they do a kind of 2-to-1 kind of borrowing limit. So my buying power is $186,496 dollars, but the amount I've invested is $93,248. So in terms of from an income perspective, the first thing you need to do with that $186,000 is to go buy shares in Apple. So if I bought $186,000 worth of Apple shares at $154 per share, that's a little over 1,200 shares. Now, the way that we make income holding stocks, and I talk about it a lot on my channel, is through, if the stock pays a dividend, which Apple does, but more importantly, selling covered calls, which is where you write an option contract to say you're willing to sell your 1,200 shares of Apple at this price at this expiration date. And for that right, the buyer of that option pays you a premium, which we'll go on to inside a second. It's that premium is where you generate income from there. And when you sell an option, you do it in multiple of 100 shares, which 100 shares equals to one contract. Now, because I have 1,207 shares, that allows me to sell or write 12 options contracts every single month. So what assumptions have I made when it comes to the kind of covered call income that I'm going to be receiving? So every single month, so I'll be doing monthly options in this fictitious example of where I would be selling 12 contracts every single month, where I would receive a conservative $100 per contract, right? Um, and in terms of what option I'm selling at, it's around a 15 delta. So what a 15 delta means is that it is 15% likely that Apple will be at or above my strike price at the date of expiration. And what I've done here is I've just taken a snapshot of the options chain just to kind of show you how conservative this number actually is. So I've gone around a month out from today's date, which makes it around June 10th, and the current price is 154. So if you select the 170 strike, so I'm willing to sell my 1,200 shares of Apple at $170 per share, and for that you will get $1.29 per share. So if we just say it's 100 shares, it's $129 per contract. So if you've got $12, that is, you know, a little over, I don't know about, I don't even know where my maths is at the moment. I'm just going to work that out because 129 times by 12 contracts, that's 1,500 a month. And I've gone with the assumption of $100 a month. So that's $500 less than the assumption that I've put in these figures. So again, I've lowballed it, and that's roughly about, what's that? It's about a 10% gap between 154 to 170. So again, that's why Apple doesn't really move that much. It's quite a big stock, you know, a lot of institution investors inside there, so it's not that volatile as other kind of stocks. So, you know, a 10% moves quite big, but what it also does is it also protects me if Apple goes down to 145 or 140. I can then move my strike down at the 10%, so I'm still above my 154 cost basis, and still maintaining around $100 a month per contract. So just want to kind of give you a snapshot of what that kind of looks like when we come into how to do this stuff. And at the end of the video, I'll share with you a video that, you know, if you're interested in, you know, selling covered calls and stuff, I'll show you a video on how to do that. So like I said, I'll be selling 12 contracts every month to make about $100 per contract. That's about $1,200 a month in my example, compared to the $1,500 at $120 per contract. Again, I'm assuming that I'm not rolling it. I'm assuming that I stay out the money. I don't get early assigned, all of those different things. Those things can happen. Apple can spike up or spike down, and then you have to get involved and do some rolling. I've just assumed that none of that happens for this plain and simple example. Similar to the rent example that I forgot to mention, that, you know, all the rooms are rented out, no one leaves during the month or gives their notice in and things like that. Again, we're just assuming the best case scenario for both assets. So then that gives us a covered call income of 14,400, not as high as the 28,000. Apple also pay a dividend. It's very small, and they're kind of trading 12 months is 0.61 percent. So again, I've done that based on the amount that I've got invested in there, so that's just over a grand. Gives us 15.5k. Again, a lot lower than the income we're going to get from renting out the property. However, this is where it changes when it comes to the cost. There are very minimal costs when it comes to stocks. So obviously you've got loan interest. I've done a 2.5% loan, which is what IBKR currently charge me at the moment, and that's the highest fee with the smallest account that I've got. And then obviously as well, you've got some commission charges, very, very small commission that they charge. I think it's about 50 cents per option that you sell. So again, working out that calculation works out to be around $72 for the year. So very small cost compared to there. And that's where, again, you make your money off the back of this, because you actually make $13,000 annual profit, which is a 14% return. So on the face of it, looking at this, I wouldn't advise putting your whole 186k into Apple, but Apple again is not a very volatile stock when it comes to option premium prices. So you could make double this amount in my view if you went into something like a Tesla or Facebook, or put half your money into Tesla, and half your money into Apple, for example. Again, there's a lot more volatility involved with that, but your premiums, your income premium is going to be a lot higher than 14.4. You'll probably get closer to around the 28,000, because Tesla is a very volatile stock and pay some really, really good premium on top of that. But I wanted to keep this example very, very simple for now, and just to show you the kind of differences. And lastly, just in terms of the non-tangible from a numbers perspective, in terms of time, effort, all of these kind of different things. Now, look, when you go get a house, you guys know the amount of effort that you need to do to go scout a house, to go find a house that, is good value for money in the right area, go visit viewings, go through a bidding process, and then you have to go through a mortgage application and dealing with solicitors, all these other different things. Don't get me wrong, there's a lot of work needs to be done to picking the right stock and all of that stuff, but that can be done in the comfort of your own home, and there's so many tools online to be able to do that. So in terms of the work needed before investing, again, stocks wins that. And then post, right? Yes, you have a management company dealing with if things break and all of these different things, but you still need to be made aware of these things, sign off the pricing, deal with renewals, and there's just a little bit more hassle or tenant complaining about a radiator busting and all these other different things. Yes, you don't have to go ring the handyman and go sort it out. That's what you pay your 15% management fee to look after, but at the same time, it's a lot of hassle. Whereas from a stock side of things on covered calls, yes, you've physically got to place those covered calls. If you don't place them, you don't make the money. But you know, you can do it in, it's about 10 minutes work a month, if that, and you go check in on it once a week just to see where you are, where Apple is trading compared to your strike price. And there's many things you can do to make more money. For example, if for example you sell, let's take this example here, if you sell the 170, right, and then Apple goes to 150 in like the first 5 days, that option price of 129 might depreciate by 30-40%, right? So you could close that option, gain 80 of the 129, and write a new contract expiring on June 10th at the 165 strike, for example, and then pick up another $90. So therefore you made 170 odd dollars, whatever it is, in the same time period. So there's a lot of things you can do there. That requires work and maintenance. You can just leave it and just take the $100, and even if you obtain most of that $100 early in the option lifespan and you decide not to create a new one, that's absolutely fine, and that's up to you depending on how passive you want to be. But if there's an opportunity to make more money in the same amount of time, most people probably go and do that. So that to me is where it is. And I'm not saying a house is not the right investment. That's not what I'm saying. It's always good to diversify your kind of portfolio in terms of your assets across different asset classes. And I just feel it's lower barriers to entry. You can start quickly. You can borrow cheaply. I don't recommend going on margin if you don't know what you're doing. But again, you can get the same amount of even more leverage, right, with stocks than you can with a house. And yes, houses may appreciate more over time, but over the time, if you look at Apple's chart, it's ridiculous. It's like 500% or whatever in the last 10-15 years. So it's you can still make money on the appreciation of the stock as well, right? At the same time. So again, all else being equal, if you are brand new and you've got around 90 odd thousand to kind of invest, I would strongly consider looking at both options, and it's whatever you're most comfortable with. Because the other thing is with stocks, especially in this current environment, you will notice that everything is down, right? But when the housing market is down, you can't physically see the price of your house unless you get it surveyed. Yeah, there's estimates online, but at any point in time, every second of the day, what your stock is trading at. And if it's down 30% and you can see it, mentally that affects you. Then if your house price was down 30%, like, you might just know house prices are down. But my point still occurs, if you're not looking to sell your stock or you're not looking to sell your house, then you're holding an unrealized loss. And I think, a lot of people think unrealized losses are really bad. But if you're making money while holding an unrealized loss, then, you're still producing that income every single month, whether it's through rent checks, covered calls, or dividends. So, I really hope you like this video. I hope this makes sense to you. Comment down below. On the screen now will be how I make, over $1,500 a month in a bear market selling covered calls. So check out that video right now.